Good morning. Happy Friday. It's the Brew. I'm your host, Lex. We have Molly waiting in the wings, and today is Vega Day, part one. There's another part to Vega. We're not going to get to all of it today, so we're going to do it in two parts. This is the beginner section, I'd say, part one. So let's get ready for this chat about Vega. So stay tuned for that opening bell. Hello. What? Molly, you're in a different environment. Holy cow. Molly's on mute. I'm unmuting Molly. Are you there?
We are on location. We are
I was going to say you're
on location.
Yeah, you're on location. I can tell. You're somewhere else. I love it.
Yes.
What's going on? Guess what?
So I'm excited.
Go ahead.
Vega Monster.
The Vega Monster today.
Vega
We're going to talk
Monster.
about the Vega Monster. Yep, we're going through all the Greeks. Last week was Greek week. We didn't get to one of them, which is Rho. So we're going to do Rho on Monday. Vega today. We're going to have to do a couple episodes of Vega. For market makers, Vega is an important Greek. So we'll talk a little bit about it. It's not probably as important for the retail folks, but we're going to chat about it anyhow. Hey, guess what?
Okay.
I went and saw Mission Impossible last night.
Oh, was it good? Did you see the stunt that he did?
Good.
I haven't seen it yet, but I've looked at that stunt he did, and when he drives off the cliff, I think he did it 6 times.
Yeah, it was pretty cool. I would not do that, I don't think. Even though I like adventure, that's a little bit much. It was really cool.
Tom Cruise.
Tom Cruise, he wore blue suits the whole movie, so I decided to put my blue suit on today.
I love it. That's awesome.
All right. So Vega, you ready for this?
I'm really ready. I'm excited about this one.
Do you know what Vega is at all? And if you don't, it's okay. That's okay. That's why we're
here. My rudimentary understanding of it is it's a measurement of the sensitivity of options compared to the price changes, implied volatility. So if implied volatility is crazy at the money and this little bell curve and it bottoms out at the tails, then Vega is a measurement of how options changes compared to that. Is that correct?
Yeah, that's pretty good, Mal. I like it. Did you memorize that?
No, I've got 6 screens. No, I did. I did research before this
You knew I was going to quiz you, right?
Yeah, I know you, Lex.
All right.
Gotta know something.
Okay, so that's good. Yeah. So yeah, Vega is the Greek that deals with implied volatility, right? That's an important metric. Part one, we're going to explain what's involved. Part two, we're going to start looking at implied volatility, versus realized volatility, and those implied volatility rank and where that all plays out for options. They're both super important to understand, I think. Probably part two is a little bit more actionable, let's say. But I'll give you a couple stories as we go on Vega. I had my best and my worst day in my life trading.
And you'll
because of
go
Vega.
Over.
Go ahead. Sorry.
You might go over. Again, I love the market maker side of it. So how Vega probably has a hand in pricing of how you guys price options. Is that correct?
Yeah, I mean, it's more than implied volatility. It's more than implied volatility that we use, but it's all, it's related, right? So you have to have a handle on all of it, essentially. And volatility was the most important number that we could pump into the model that would give us good values for what the value of options are or were, right? So that was super important. What implied volatility you use, how we used it, all that kind of good stuff. Hey, by the way, thinking of Vega, I just thought of something. Yesterday, we remember in the morning, we opened up gigantic, right? So the market, I think the NASDAQ was up 200 points on the opening yesterday. And this is an example of how volatility can be really powerful. So we opened up, I want to say 200 points in the NASDAQ, maybe 40-ish in the S&Ps. The Dow was lighter. By the end of the day, we were down in all those markets. So the NASDAQ finished down, some goofy number 71 after being up 50. That's a massive intraday range. The Dow Jones was down 237. I think it was up like 80 or something at some point. I'm sorry, the NASDAQ was down 77 after being up 250 or something like that. 320 point range. That's volatility, right? And that's where option pricing becomes important, because as that movement starts getting more, people are going to start, whether they're calls or puts, it doesn't matter. Start raising prices as people start buying more and more of them. It's a supply and demand game, right? That's all these things ever are. But Vega will give you a metric, a sensitivity in your portfolio as to what implied volatility can do to your inventory and, more importantly, your P&L. Okay. Sense? So far, so good?
Okay, so
and I'm going to go to the share screen. Watch this.
Okay. Oh, I love this. And by the way, just a note for all the viewers. So because we're on location, my Wi-Fi is a bit spotty, so you're coming in and out. So I'm going to do the best I can today.
That's okay. Don't worry about it.
Just notate
Don't worry about
that.
it. I'm going to yap most of the time anyway, right?
You're good. I love this. I love these slides.
All right, Mal, I'm not sure you're old enough to remember.
That car.
I'm not sure you're old enough to remember the Vega. This is the Chevy Vega right here on the right. I remember it. I don't think I was old enough to drive back then, but I do remember the Chevy Vega. There it is, right there. Beautiful Chevy Vega. Why the teeter-totter? I had this idea of the teeter-totter only because Vega is one of those kind of things. It's kind of high and it's kind of low, and it kind of swings back and forth. Volatility. So it's a handle we need to get a hold of, right? Let's do some definitions. What do you think? Next slide, please. Here we go. Hold on. I got to do next slide. I'm saying that to myself. Don't worry, Max. I got it. All right. So here's I'm not going to read all this, but I'll try to paraphrase. So as you said, options, the term Vega in options is a measure of an option's price sensitivity to changes in implied volatility. Okay. Simple enough. If implied volatility goes higher, the option prices go higher. Okay. If implied volatility goes lower, the prices of the options go lower. Okay. That's the effect of it. It's very simple. That's an easy one, right? The metric that we use in the industry is a 1% move in implied volatility is the measurement of, how Vegas sort of talked about. So what does that mean? If you have an implied volatility that you're using is 25, let's say, okay. And remember, 25 is really 0.25 as a percentage on an annualized basis. Okay. So it's going to move 25% over the course of a year is what that means. Okay. Now we can hone this down into 1 day volatility, and we're going to do that on another show because there's a formula that you can use to figure out what a 1 day move looks like relative to, in our example, 25 volatility. But we're not going to do that now. So 1% is the benchmark. Okay. Up or down. Let's look at a couple examples. So on the left, we have option price, various option prices. We have a $5 option price. The Vega of this option, as an example, is 25 cents. Okay. So if implied volatility goes up 1%, okay, you can see that the estimated option price is 5.25. It's just simple. The Vega up 1% is 1 unit. It adds 25 cents to the price of that option. If we go down 2 implied volatility percentage points, okay, we're going to lose 25 cents twice, or 50 cents. And thus that $5 option becomes $4.50. Making sense? What do you think, Mal?
Yes, you are cutting in and out, but I love this slide. So this is great.
Okay.
So we're just hanging on here on live TV.
Got it. And then you can see what happens along the way. I'm not going to go through each of these. 720, 10 Vega goes up 1, adds a dime to that. Now it's 730, goes down 2, takes 720 to $7. Okay. So on and so forth. So that's how Vega is measured. That's what's kind of happens. Now I've thrown a term out there called implied volatility. Okay, there's two types of things to think about with volatility. Well, there's more, but there's two main ones: implied volatility and historical volatility. Implied volatility, okay, this is a projected volatility. So it's what the options are implying as an estimation of how volatile that underlying asset is. Okay, so implied volatility in options is more of a forward-looking item, right? It looks forward into the future to provide some sort of forecast as to what the market and the market makers believe that underlying asset will be. Okay. Does that, any questions there? I want to make sure that makes sense.
Absolutely.
I know you're on tape delay a little bit, but yeah, this makes sense, right?
This is perfect.
Okay. Historical volatility, it has different names. Historical volatility, some people refer to it as, I've heard forecast, I've heard realized is the main one. I use realized a lot too. But historical or realized volatility looks at the past data of the underlying asset and computes what the past data looks like as a volatility number. Okay. So these two volatilities, implied and historical, can fight with each other. Now, clearly you can see where this is going to go, right? If implied volatility is too high relative to historical, what would you want to do? You typically would want to sell implied because the market seems like it's implying way too much movement for what the actual data looks like for the relativity of volatility of that underlying asset. So if the asset's only moving around at 20 vol, right? And your options are saying, hey, we're going to trade at 30 implied volatility. Well, why wouldn't you sell 30 and buy 20 and try to manage that inventory with the expectation that implied is going to mean revert to some sort of historical number? Does that make sense?
Got it. Yes.
Okay. So these numbers are what a lot of the, I'd say the market making pro traders look at, because the pros, the market makers, the dealers, whatever we're calling them, they have inventory. And when you have inventory, the Greeks affect that inventory. Vega affects it. Gamma, theta, rho, delta, all of those Greeks affect dealer inventory, and they are in the business of not having any real exposure anywhere along the way. Market makers will take a Vega bet. That's a bad word, but they'll take a Vega position based on where implied volatility is relative to some historical measures about that implied volatility. Okay, so if it's super low, they may be, long a little Vega with the expectation that vol is going to mean revert back to some higher level. If implied volatility is way higher than some mean number, that might be short Vega overall in an inventory, so that when implied volatility mean reverts back to that norm, it comes back down, they make money on that version of it. Questions? Anything?
Got it. And how often are they right? How often are they wrong?
Well, that's a great question. Let's get to that in a second. Let me do this. Max, I'm gonna take over on this one because I'm gonna share a screen, if that's okay. No, I'm not.
Sorry, you cut out. Say that again.
No, I was gonna have Max share the screen, but I'll just read it. The market just opened. Let me just run to that real quick. So guess what? Dow up or down, Mal? What do you think? Any guess?
Down.
Wrong. So remember our big sell-off yesterday? We're back up to where we started yesterday. So Dow Jones is up 200, NASDAQ up 152. That's 1%. That's a nice move. S&Ps are up 35. That's about 0.75%. VIX down $1 to 1346. So VIX, the volatility indicator, is getting hammered today. And that's how we're looking at the market. So, all right, let's look at Vega versus strike price. Okay, we're just rolling along here, aren't we? Actually, you know what? I'm gonna go back.
I do have questions, but I'm gonna save those for later.
You want to save them for the end? I know I'm wafting in and out on the hotel Wi-Fi. All right, so let me make another comment here. And this is for part 2 when we do Vega part 2. implied volatility versus actual is a measure that we have in TradeHawk, our options trading software at Tradier. We show the connectivity between actual at a historical implied volatility and realized volatility. So there's a great metric in there that we're going to go over in part 2 of understanding where implied is versus actual on a historical looking back basis with current volatilities. And we can look at implied volatility ranks, and we can look at implied volatility percentiles. They're different, okay, but they're also numbers that are very useful. So we'll talk about that in part 2, okay? So hope that makes sense. Okay. Vega versus strike. Where is Vega the most pronounced? Well, this is building back again on our discussion about theta and where in intrinsic value and extrinsic value. Remember, we talked about that the other day. So Vega is sensitive to extrinsic value or time value premium. That's what it has the most effect to. Remember, parity can't really change too much. The only way parity changed, again, this is another topic, is with dividends and interest rates. Parity can have some profound effect. But in terms of where Vega has sensitivity, it doesn't do anything to parity. Parity is just an absolute number, right? It's the in the money value of an option. So we're not changing that. That doesn't change. What changes is that extra intrinsic value above and beyond parity. And that's where the strike is interesting. So at the money options, you can see in this graph is that dotted line. And you can see the Vega peak way up here on that at the money. That's where the Vega is the most sensitive. Out of the money is all extrinsic value, but that premium is less as the farther you go out of the money. Deltas are getting smaller. So the bulkiness of that premium, that extrinsic value, is coming down with smaller delta options. Conversely, in the money options start having parity, and they don't have as much time value premium and thus aren't as sensitive. So you can see right around that band of at the money is our Vega, big daddy sweet spot. Go ahead, Molly, you had a question. Sorry.
So there's an inverse relationship there. So could you talk about the option premiums being a little bit more expensive the further they are out?
Yeah.
When we're
okay. So guess what? Next slide. Oh, see, I anticipated the question. Unbelievable.
You are good.
Wow.
This was not planned.
That wasn't planned, actually, but unreal. Okay. So Molly's question is a question on relationship of that time value premium in Vega based on expiry, right? So where is Vega sensitive? So you can imagine that with minutes to go, the time value premium has decayed out of the option, and it has a short life to live with very little time left on the expiry. So therefore, Vega is not going to be as profound in near-term months, right, versus longer-term months. So as you can see on the graph, and I don't see if you can see the colors, the blue is a 15 DTE, days to expiration, okay? So 15 is not a long time. You can see it has a very much smaller Vega number. And let me just get my mouse around it. It's very small here. It's under 0.20. Midterm, 71 days, just under 4 Vega. And then we go 225 days, and it's what, 65.65, thereabouts, Vega. So the farther out in time, the more sensitive Vega will be to your position in your inventory. There's a lot more time value premium the farther out you go. And I use the word time value premium a lot because it's instructive. Time value, how much time is left in this option. It just makes intuitive sense to people when they're learning options. Time value premium, the longer out you go, the bigger that is because there's more time for that stock to move around and be in the money, out of the money, and all over the place. So there's more of an insurance policy, and that's where that premium kind of piles in. And thus Vega is more sensitive in deeper post-dated options and expiries. Make sense, Mal?
Yes.
You are just like, Lex. What the heck?
I'm learning. This is amazing. I love your slides.
You do?
We're happy over here.
Okay, good. All right. So now, let's talk about real quickly, how does Why is this important? The market making community, and I mentioned this earlier, has a different take on this than the retail. So what retail folks generally like to do is they have a reason for putting on a position, and they have a distinct ability to say, I want to put on an iron condor, or I want to put on a put credit spread or a call credit spread, whatever it is, butterfly, you name it. Okay. And they construct that trade and put it on. And now the reasons for putting it on can be varied, right? I think the stock's going to go up. I think it's going to go down. I think it's going to stay sideways, whatever those reasons are. Conversely, market makers don't have that ability. Market makers are reactionary or reactive to the order flow that comes into the pit and pays their offer and sells their bid. They don't know what's going to happen. They have no idea. They just know that they have a two-sided market. They have to trade on both sides of that market, right? And when they do that, they're left with a position. It isn't an iron condor. It isn't a butterfly, right? It's just stuff, and stuff accumulates. Just like in a warehouse, if you have products that you're selling and you got too much of it, right, and it's not selling, what do? You have a sale, right? And when you have a sale, you lower the prices and you try to get out of it. Just like in market maker inventory, okay, if you're getting too much of one thing, whether it's short or long, at some point you're gonna have to either, you liquidate, or you raise prices, or you lower prices to make your inventory sort of mesh well, right? And there may be reasons at certain implied volatility points, if they're exorbitantly high, that you want to keep short inventory on. Conversely, if implied volatility is very low and it's pounding you, right, you may want to keep some long Vega in your inventory, because the hope is, and the concept is that implied volatility is mean reverting. And if it's really low under the mean, it should snap back. It doesn't have to, but it should snap back. So you put your edge in the favor of snapping back, and you might have a little bit long Vega there. So you can see the difference, I hope, of retail folks versus market maker. Market maker folks have to react to markets and get stuck with inventory. Retail folks can choose their inventory. There's a big difference. Questions? Sorry, Mal. You were going to say something. Molly,
yeah. So,
Molly.
And again, you're. Can you hear me?
I can hear you. We're on a little bit of a tape delay. That's all.
Okay. Thanks for the patience, everyone. So, could you speak to when Vega is higher than the call put spread? That
I don't understand what that means. Say that again.
So I've read somewhere where if the Vega is higher than the put call spread, then it's a good deal. Is that incorrect?
I'm not sure I understand. So is this Vega in your position, or the Vega of the option? What do you think you're asking?
So I'll just read it. So this I researched is if the Vega of an option is greater than the bid-ask spread, then the option is said to be a competitive spread.
Oh, I've never heard that before. That's interesting. I got to think about that one. So I think that question means,
I had never heard of that either.
Yes, I think that means if the actual Vega of that option is a bigger number than whatever the width of the bid ask, the statement was that that's a good option or a good price or a bad price. Molly's on tape delay again. Whoops, she's back. She's back.
Right. This is back. Good. So are you going to show us? We're still getting our legs underneath. So this is our first on location.
I was going to say, you must be in fancy Beverly Hills or something. They don't have good Wi-Fi there.
We are. I'm surprised that they don't have good Wi-Fi, but we're going to have to invest in some sat phone. You'll see me with some satellite on my head next time.
All right. Let me tell a story before we go. So, because your volume or whatever, your audio is in and out. Can you hear me now?
Yes. Perfect.
So my story about Vega, when I was a market maker, we had a firm, right? So it wasn't just me standing down there, our whole firm. Our best and our worst day, was a result of Vega. Single trading day.
Wow,
our best P&L day and our worst P&L day was because we were in the worst, obviously, we were on the wrong side of Vega, our positions. And our best was that because we were on the correct side of Vega. So think about this too before we leave. We got 1 minute. What is the trade-off of being long Vega? And I don't expect you to answer this. I'm going to tell you the answer because we're short on time. So if I'm long all these options, that's creating Vega in my inventory. What's the negative side of that? Theta. When I'm long all this stuff, all this time value stuff, theta is my enemy because I'm long it. It's going to decay. We talked about this on the theta episode. Options are going to waste away like an ice cube as time goes on. So if I have all this stuff that I'm long Vega, my trade-off is I got to manage it. And it's going to decay day in and day out. How do I manage it? Well, when you're long Vega, you're also probably going to be long Gamma, potentially. Not necessarily, but we'll talk about the nuance. And you can scalp the movement in the underlying stock. And that's what market makers do. When it goes up with long Vega and Gamma, they sell stock. When it comes back down, they buy it back. That little scalp of positive P&L is going to offset the theta every day. And they're trying to it's like treading water. I always thought of being long Gamma and long Vega and long options like treading water with army boots on and a whole jacket and a hat. And you're up there just trying to keep your head above water every day, right? Trying to keep finding land. And when volatility explodes, you take all that stuff off, you get out of the water and you sell it and you're done. Voila. See how easy this is?
And then conversely, conversely, a retail trader can probably be on the other side of that and use those same metrics.
And again, we'll delve into this
side as a buyer.
Yeah, we'll delve into it as shows go on. That's right. But yeah, retail traders don't have the ability to buy bids and sell offers like market makers do. That's their job. Retail traders are the opposite. They tend to buy the offer and sell the bid, or somewhere they hope somewhere in between if the market's wider. So they don't have the ability to buy bids and sell offers and generate that kind of P&L to offset any sort of Greek risk that they may have. So that doesn't exist. That's why they have directional and volatility sort of plays for retail folks. And we'll really delve into the over the course of these shows into the things that retail traders can do for edge. There's a lot of stuff out there, right? It's just different from a market maker. That's all. All right, Mal, I'm gonna let you go enjoy the vacation because we're at time. And guess what that means? We're done for Vega part 1 for today. Are you so happy?
Right. Well done. I'm gonna have to review this. You were cutting out a lot, but this is one of those juicy episodes that you can stop, replay.
Yeah,
this is absorb it over time. So this is a good one.
Good. Important stuff. All this Greek stuff's important. It's a good foundation especially for beginning traders. You should know all this stuff. You might not use it all, and especially row, but it's great stuff to understand because it's going to give you a different perspective when you're looking at an option chain when you know this stuff. Trust me, I promise. All right. Okay, we are gonna go to the closing bell. Are you ready? Ding, here it comes.
All right.
Have a good weekend.